It took me 18 years to learn what I'm about to tell you. A client of mine, I'll call him David, spent 8 months finding the right business to buy. 44 years old, corporate career, saved over $200,000 for a down payment, found a manufacturing services company generating $1.8 million in revenue, $380,000 in SDE, asking price $1.6 million. Perfect fit. Terms that made sense. He was ready. He applied for an SBA 7A loan, got pre-qualified, went under contract, paid for due diligence, hired an attorney. 8 weeks into the process, the lender flagged a problem with the seller's financials that David had been warned about 3 months earlier, but hadn't documented correctly in his loan application. The lender was ready to decline the loan. $200,000 down payment at risk, $18,000 already spent on due diligence and legal fees. The deal was 72 hours from falling apart. We fixed it. The loan closed. David owns the business today. But the 3 days it took to fix a problem that should never have existed cost him sleep, cost his family anxiety, and very nearly cost him the acquisition he had spent 8 months building towards. The problem was not the business. It was not David. It was not the lender. It was a set of things about SBA acquisition financing that nobody had explained to him before he started the process, because nobody who understood the full picture had ever sat down with him. If you're thinking about buying a business with an SBA loan, or you're already in the full process, this video is specifically for you. In this video, I'm going to walk you through how SBA acquisition financing actually works, the loan types, the qualification requirements, the timeline, and what lenders are actually evaluating when they review your application, and the 5 most common mistakes that kill SBA acquisition deals before they close. Be sure to listen to the end, because at the end of this video, I'm going to tell you the single most common reason SBA acquisition loans get denied at the last minute. It's not what most buyers assume, and knowing it before you apply could save your deal. I'm Matt Ewell, founder of Ridge Trail Capital, 18 years, $250 million in M&A transactions. If you're looking to buy a business and nobody has walked you through how SBA acquisition financing actually works, what lenders look for, what kills deals, and what you need to know before you make an offer, that gap is exactly what this channel is for. We publish a new video every week, so make sure you hit that subscribe button for any updates. Let me start with the basics, because there's a lot of misinformation about SBA loans in the context of business acquisitions. Most of it from sources that understand banking but don't understand the specific dynamic of buying an operating business. The SBA, Small Business Administration, does not lend money directly. It guarantees a portion of loans made by approved lenders, banks, credit unions, and non-bank lenders. That guarantee, typically 75 to 80% of the loan value, is what allows lenders to extend financing for business acquisitions that they would not otherwise approve on conventional loan terms. For business acquisitions, there are 2 loan programs you need to understand. The first is SBA 7A. It's the most common and most flexible SBA loan program for loan amounts up to $5 million. Can be used for business acquisition, working capital, equipment, real estate, and refinancing existing debt. Often in a single loan, terms up to 10 years for a pure acquisition, up to 25 years if real estate is included. Down payment, typically 10% of the purchase price if the business is considered a full value acquisition. The SBA 504 is more structured. It's designed for fixed assets, equipment, and real estate rather than pure business acquisition. It involves 2 lenders. A conventional lender covers 50%, a certified development company covers 40%, and you bring 10%. If your acquisition involves significant real estate or heavy equipment, the 504 can provide better long-term rates. If it's a service business, the 7A is almost always the right vehicle. Here's where most buyers are operating with incomplete information. When you apply for an SBA acquisition loan, the lender is not just evaluating you. They are evaluating the business you're buying, and they are evaluating the combination of you and that business together. The 3 things that determine whether your application gets approved, gets modified, or gets declined are the strength of the business's financials, specifically its debt service coverage ratio, your personal financial strength, credit, liquidity, industry experience, and the quality of the documentation provided by the seller. The third factor, seller documentation quality, is the one that kills most deals and that almost nobody warns buyers about before they go under contract. With more businesses coming to market than at any point in recent history, and SBA lenders processing more acquisition loans than ever, the underwriting process has become more rigorous, more document intensive, and less tolerant of the gaps in seller financials than it used to be. Let me walk you through the 5 most common reasons SBA acquisition deals fall apart. After the buyer is already under contract, already spending money, already emotionally committed to the acquisition. Deal 1, debt service coverage failure. The debt service coverage ratio is the single most important number in the SBA acquisition loan. It measures whether the business generates enough cash flow to cover the loan payment. The SBA requires a minimum debt service coverage ratio of 1.25 times, meaning for every dollar of annual debt service or payments made, the business generates $1.25 in net cash flow available to cover it. Here's a problem most buyers don't see coming. The debt service coverage ratio is calculated on the business's adjusted financials, the real SDE, not the asking price the seller set. And if the seller's asking price implies a loan amount that produces annual payments the business cannot comfortably cover, then lender will decline or require a higher down payment to bring the loan amount down to a serviceable level. A buyer who puts $1.6 million under contract, pays $18,000 in due diligence, and discovers that the debt service coverage only works at 10% down if the SDE numbers hold, and the SDE numbers have a question in them, is exactly where David was. Calculate the debt service coverage on every business before you make an offer, not after you're under contract, before. Deal killer number 2, seller tax return inconsistency. Lenders will verify the business financials against 3 years of tax returns. If the P&Ls presented by the seller show significantly different numbers than the tax returns, which is common in small businesses where owners have historically minimized taxable income, the lender will use the lower tax reported numbers to calculate debt service coverage. A business that shows $400,000 in SDE on the broker's adjusted P&L, but only $240,000 in taxable income on the tax returns, will be underwritten at $240,000 for loan qualification purposes. This is not the same business. This is the single most preventable deal killer in SBA acquisition financing. Ask for 3 years of tax returns before you make an offer. Calculate the debt service coverage on the tax return numbers, not the adjusted P&Ls. Deal killer 3, seller note and standby requirements. SBA lenders often require the seller to carry a note, essentially financing a portion of the purchase price themselves, especially when debt service coverage is borderline or when the business is highly dependent on the seller's relationships. The typical requirement is 10 to 15% of the purchase price. This creates a negotiation dynamic most buyers aren't prepared for. If the seller is expecting all cash at close and the lender requires them to carry a $160,000 note on a $1.6 million deal, the seller may push back. Understand the seller note requirements before you make an offer. Build it into the conversation early. Deal killer 4, buyer industry experience gap. SBA lenders want to see that the buyer has relevant experience to run the business they're acquiring. This doesn't mean you need 20 years in the exact industry, but it does mean you need to be able to articulate a credible management plan and demonstrate that your background prepares you to operate this specific business. Most buyers submit a resume and will assume the lender will make the connection. The best buyers write a specific, detailed narrative of why they are the right operator for that specific business. That narrative can be the difference between loan approval, a request for additional documentation, delays, or a decline. Deal killer 5, insufficient working capital planning. SBA loan covers the acquisition price. They do not automatically cover the working capital you need to operate from day one. And if your down payment is being fully consumed by the equity requirement in the acquisition, you may be closing on a business with very little operational runway. I have seen buyers close acquisitions and run into working capital stress within 60 days because they did not model the cash flow requirements of the transition period. SBA 7 loans can include a working capital component. Build it in from the start, not as an afterthought. I've put together an SBA loan buyer's guide. It covers the full qualification framework, the debt service coverage calculation walkthrough, the documentation checklist lenders require, and the questions you should ask any lender before you submit. If you're in the process of buying a business or planning to, and you haven't modeled the debt service coverage on that business or build a documentation checklist into your due diligence process, that guide is specifically for you. Most buyers who go through it discover at least one gap in their preparation that could have delayed or derailed their acquisition. Download it for free by clicking the link below. Here's the practical framework. 3 moves in order of impact. Move 1, calculate debt service coverage before you make an offer. This is non-negotiable. Before you put any business under contract, calculate the debt service coverage ratio on the tax return number, not the adjusted P&Ls, not the broker's valuation summary, the tax returns. The formula, take the business's net income plus depreciation plus amortization plus owner's salary and reasonable add-backs. That's your cash flow available for debt service. Divide it by the annual payment on the proposed loan amount at current SBA rates. The result needs to be 1.25 times or higher for a standard SBA approval. Move 2, use an SBA lender who specializes in acquisitions. Not every SBA lender is equally equipped to process an acquisition loan. Community banks that primarily make SBA loans for real estate or equipment may not have the experience to navigate the additional complexity of buying an operating business with a seller note, an earnout, and a transition period baked in. Ask every lender in your interview, how many SBA acquisition loans did you close in the last 12 months? What's your average time from application to close on an acquisition? Choose the one with the specific answers. Move 3, the number 1 reason SBA acquisition loans get denied at the last minute. I promised you this at the top of the video. Here it is. The single most common reason SBA acquisition loans get denied at the last minute, after the buyer's under contract, after the due diligence is complete, after weeks of back and forth with the lender, is not the debt service coverage ratio. It's not the buyer's credit. It's not the seller's financials. It is the business equity injection documentation. The SBA requires that the buyer's down payment, the equity injection, come from a documented, verified, legitimate source, not borrowed funds, not a gift that looks like borrowed funds, not money that appeared in a bank account 30 days before closing without a clear explanation. Lenders are required to verify the source of every dollar of the down payment. If you have $200,000 in savings and $50,000 came from selling a property 18 months ago, $50,000 came from a 401k withdrawn last year, every one of those transactions needs to be documented and traced. Bank statements, closing documents, withdrawal records, all of it. The buyers who get denied at the last minute are not people who are doing anything wrong. They are people who didn't understand that. I have the money, it's not the same as I documented where the money came from. Start your equity injection documentation on day 1 of the process, not 30 days before closing, not when the lender asks for it. Day 1. Gather every bank statement, every transaction record, every document that traces the source of every dollar you're bringing to closing. That's the single most actionable thing you can take away from this video. Let me get back to David for a moment. When we fixed his deal in those 72 hours, what we fixed was the equity injection documentation. He had $200,000 for his own down payment. Every dollar of it was legitimate, but he hadn't traced $60,000 that had moved between accounts 2 years earlier, and the lender couldn't complete their verification. But he hadn't traced $60,000 that had moved between accounts 2 years earlier, and the lender couldn't complete their verification without documenting that transfer. 2 years, $60,000. The paperwork to document it existed, it just hadn't been gathered. That oversight, that one gap in preparation, nearly cost him 8 months of work, $18,000 in fees, and the acquisition he spent a year building towards. The 5 deal killers in this video are not unusual. They are the most common things that happen in SBA acquisition loans, and every single one of them is preventable. if you understand the process before you start it. That's the difference between a buyer who closes and a buyer who doesn't. If you're in the process of evaluating businesses to buy and you want to walk through your specific situation, what financing structures make sense, whether the deal you're looking at is debt service coverage viable, and what you need to prepare before you make an offer, book a free call by clicking the link below. No pressure, no pitch, just your specific numbers and an honest conversation about whether the deal you're looking at makes sense and how to finance it properly. The link is in the description. We'll see you in the next one. Because the best deals go to the buyers who know exactly what they're looking for before they start looking.